Good afternoon and welcome back everyone to Moneycontrol live stream. You're watching the closing bell and I'm Santosh Nair. Well, mid-caps are getting pounded today as the bears are tightening their grip on Dalal Street. Well, it's a broad-based sell-off, the kind that we've not seen for quite some time now. Mid-cap indices are down by almost more than 3%, while benchmark indices themselves are down by close to about 2% as we speak. Most critically, the Nifty is now fallen below the critical 18,000 to 18,000 mark. In fact, 18,200 was the mark it had breached the day before, and today it's almost fallen below 18,000. So that's a big cause of worry for those traders who track technical analysis closely. Well, what exactly is causing this massive sell-off in the market? As it's the case always, there's no just one factor. It's a combination of many aspects coming together and leading to this kind of a sell-off. So it started sometime last week when the US Federal Reserve indicated that its terminal rate, which means that the rate at which it will eventually stop hiking rates, well, that could be in excess of 5%. Now, for a long time, market had been betting that the rate is likely to be below 5%. In fact, it is closer to about 4.6% was what the market was betting on. But with that assumption having changed, the first round of sell-off started sometime last week, and this week when the Bank of Japan tweaked its yield curve control by saying that now the 10-year yield on Japanese bond could now move up by 50 basis point. Indirectly, it was hinting that it was finding it difficult to keep interest rate lower, and suggested that it was one way of suggesting that interest rates could now climb. Now, why is that important for the world markets? That's because Japanese yen is one source of liquidity. Because of low interest rates, many investors, the global investors, they borrow in yen and then deploy those assets in other assets, typically emerging markets. Now, with interest rates on yen rising or likely to rise, that means that these carry trades won't be as profitable as they were before, which is one of the reasons probably that many global investors would have started cutting back positions which they had taken in other asset classes based on their borrowing in yen. So that was the second factor that led to this kind of that was a build up for the sell-off that we are seeing in the last couple of days. In addition, now the US Federal Reserve has been now getting into the quantitative tightening mode. So far it had been easing, but now it's actually started to tighten, which means that it stopped buying the bonds which it used to buy every month in a bid to provide stimulus to the financial markets. So not only has it reduced the quantum of bonds that it has been purchasing, in fact it might start unwinding some of its position, so which means that another source of liquidity for the market is now under pressure. And lastly, we have valuations. Now, India has been one of the better performing markets globally this year. That's largely because our macros were in a much better shape compared to most developed markets and emerging markets. But that has also led to a situation where some of the other markets are now beginning to look more attractive than India. Besides that, the second quarter earnings season did not have any major surprises, positive surprises that is, which is now leading players to think that the valuations just about don't leave much room for upside, particularly in mid caps, where most companies just about manage to meet market expectations, or in many cases the numbers were below what market was expecting. So with not much valuation comfort there for the market, traders and investors have started cutting back their position. That's what you're seeing, heavy selling pressure today in mid-cap stocks. The mid-cap indices, the NSE mid-cap index is down by close to about 3% as we speak. And lastly, FII flows. There'd been a pickup in FII flows starting October this year, but once again of late you're seeing some bit of hesitancy there, and more importantly, domestic inflows from mutual funds, which was a major driver of the market so far, that is also now beginning to moderate a little bit. We actually saw we clearly saw that in November when equity flows turned negative, although SIP flows continue to remain quite strong and exceed close to about 13,000 crore every month. So combination of factors there, and this besides the fact that whenever stock prices tend to fall, margin calls come into play, which means that brokers ask for more margins from the investors who are holding positions, investors and traders, and if the traders are unable to meet the margin requirements, then the brokers square off their position. So, this is also leading to further pressure on stock prices. So, we are seeing right now a combination of both fundamental as well as technical factors which are dragging the market lower as we approach the year end. A quick look now at the trade setup for the day. Both Nifty and Sensex are set to end sharply lower today, down by close to about 2%. But more worrying is the fact that the Nifty is now in danger of breaching the 17,800 mark, which is the next crucial support level after 18,000. It did breach that mark briefly, and now any close below this level could possibly trigger fresh round of selling pressure according to technical analysts. European shares are slightly higher, but overall the mood in global markets remains quite cautious at this point in time. The India Volatility Index or VIX is up by about 5%. It has now exceeded 16 now. The reading is more than 16. Now, typically what this indicates is that a higher VIX reading means players are expecting the market to be volatile in the days ahead. So, a lot of them buy put options, which is to hedge their position or hedge their losses in case the market falls further from these levels. So, excess buying of put options clearly is a sign that I beg your pardon, players are bearish in their outlook on the market. Pharma shares have been one of the outperformers, but it is not saying much because pharma shares overall, the pharma index is also in the negative today, but less compared to some of the other sectoral indices which are deeply in the red. For the second day running, auto, metals and PSU banks, these are the three sectors which are severely under pressure, with these indices falling by more than 1.5 to 2%. Pharma index is down by close to about 0.2%, but on the whole, pharma being a defensive sector, we are seeing some kind of buying interest in many of the frontline stocks. Divi's Lab is one of the gainers in the Nifty at this point. Among the major losers, we have Adani Ports, Adani Enterprises, metal majors Hindalco and Tata Steel, which are down close to about 4 to 6%. Tata Motors is also among the big losers today, down by close to about 4%. And in FNOQs, we are seeing unwinding of long positions in futures of Amar Raja Batteries, City Union Bank, Page Industries and Dixon, and we are seeing build up of long position in Divi's, Biocon and Syngene. And with that, let us move on to the stocks on our watch list. Apollo Hospital Enterprises is one of the stocks which has managed to hold ground in a volatile market today. According to brokerage house Kotak Institutional Equities, the medium term outlook for Apollo Hospital Enterprises remains quite robust. Now, the fundraising that the company had done in Apollo Health was one of the cause for concerns for the market, but according to Kotak, even without the fundraise, the company could have managed because free cash flows in both its offline pharmacy as well as the main hospital business have been pretty robust. So, between FY20 and FY22, the pharmacy and the hospital business generated close to about 1,960 crore worth of free cash flows, and this has more than made up for the 10 billion rupees, that is roughly 1,000 crores, which the company had invested over the previous 10 years between FY10 to FY20. And according to Kotak Institutional Equities, profitability in Apollo's both mature as well as existing hospitals has been improving. And what places Apollo Hospital better than its peers is that bulk of its capex is already over, and now the company is actually looking to improve efficiencies. This is in stark contrast to other hospital majors which are right now in the midst of major expansion plans, which means that the margins could be under pressure in the medium term. Also, the price target that Kotak has set for Apollo Hospital Enterprises is 5,470 rupees, which is a good 15% higher than where the stock is trading at current market levels. Vesuvius India is the next stock on our watch list. This stock has been flat in trade today, seen a fairly good run up. In fact, it is trading closer to its 52-week high. Now, interesting trend given that most steel stocks are under pressure. Now, Vesuvius India reported double-digit growth for 3 quarters in a row. Even its second quarter numbers, that is the numbers for the quarter ended September, were pretty strong. Now, the company is into manufacturing and marketing of refractories, which is a key component in the steel industry. And the outlook on the Indian steel industry remains pretty robust. About 15 to 20 million tons of steel capacity is likely to be built over the next 2 to 3 years. Also, in the case of Vesuvius, the company has been able to pass on higher prices onto its customers according to Moneycontrol Pro, which means that it was being able to maintain and protect its margins. Abbott India is the next stock on our watch list. The stock again closer to its 52-week high. Now, this is a company which is largely focused on the domestic pharma business. So, what places it apart from its peers is that the company is not subject to the kind of pricing pressure that is seen in the US drug market, which has been one of the major bugbear for most other pharma companies. Also, the company's balance sheet is quite healthy according to Sher Khan, which has a buy recommendation on the stock. And the stock has also been looking good on the charts, forming higher lows and higher highs. The stock had peaked in October 2021 last year, but now it's closer to that mark now and could even break that level. And the last stock, or rather the bunch of stocks on our watch list today, is the PSU banks. Now, these stocks saw a sharp run up in the last couple of months. There's been a dramatic re-rating for PSU stocks, PSU banking stocks in general. That's because asset quality saw significant improvement. Credit growth has been pretty strong, but at this point, given the sharp run up in prices, investors are tempted to take some money off the table. And also, in the case of many of the PSU banking stocks, the increase in market capitalization, as some analysts have pointed out, has been driven by the increase in equity base. So, it is not as though the stocks have really done that well. There is also a certain element of the equity base coming into play at this point in time. And before we wind up, let us take a quick check on the markets. Indices continue to be under pressure now. The Nifty is at 17,800, just barely holding above the crucial 17,800 mark. It's down over 300 points over the previous close. The Nifty Midcap is down by close to about 1,000 points, and it's down by over 3%. Well, and that's all that we have in this edition of Closing Bell. Thank you for watching, and we'll be back with you again on Monday, 9 a.m. For all news, views and analysis, stay logged on to moneycontrol.com.